Okay, let's unpack this. You're deep into preparing for a really significant exam, and the landscape of group audits and consolidated financial statements might feel like navigating a dense, sometimes overwhelming forest of rules and regulations.
Hmm.
But don't worry, that's precisely why we're here. Consider us your expert guides on this deep dive, ready to help you turn that dense forest into a clear, navigable path directly to exam success.
Exactly right. Our mission today is laser focused on you, the diligent learner. We're going to distill all the crucial concepts from your source material,
Right.
helping you grasp not just what these terms signify, but how they apply in actual real-world scenarios, and more importantly for your immediate goals, how they translate into exam-style questions.
Okay.
We'll be using the precise language, terminology, and yes, even the tone found in your study guide, ensuring you're completely comfortable with every nuance and ready to articulate these ideas with confidence.
That's the shortcut we're talking about. Think of this as your intensive training session, getting you well informed and fully equipped to tackle any curveball your exam throws your way.
Mhm.
We're going to cover everything. We'll start with the foundational principles of consolidated financial statements, then move into the nitty-gritty of audit considerations, the critical adjustments you need to understand, reporting requirements,
And crucially,
and crucially, how to properly leverage the work of another auditor.
yes.
To really solidify your understanding, we've even got a comprehensive case study to walk through, structured just like what you might face on your actual exam.
What's truly fascinating here and vital for your exam performance is that auditing consolidated financial statements extends far beyond merely crunching numbers.
Right.
It's about understanding the financial heartbeat of an entire economic entity, a group of companies functioning as one. This deep dive will ensure you don't just memorize isolated facts, but truly connect all the dots, building a robust framework for application.
All right, let's kick things off with the absolute basics, grounding ourselves in the core concepts. What exactly are consolidated financial statements, often shortened to CFS, and how do they really differ from the standalone financial statements that we're generally more familiar with?
Fundamentally, consolidated financial statements are the financial statements of a group,
Okay.
where the assets, liabilities, equity, income, expenses, and cash flows of the parent company and its subsidiaries are presented as if they belong to a single economic entity.
A single entity, got it.
Contrast this with separate financial statements, which, as the name suggests, show the financial position and performance of just one individual entity.
Right.
CFS, therefore, provide a comprehensive overview of the entire group's operations, its overall profitability, and its financial health, all under the ultimate control of the parent.
So it's about seeing the entire forest, not just individual trees. It sounds like a powerful tool for understanding a business. Can you illustrate this concept a bit more clearly, perhaps with a simple structure?
Absolutely. Imagine parent company, MNO Ltd.
Okay.
It has two subsidiaries, ABC Ltd. and XYZ Ltd.
Right.
Each of these entities, MNO, ABC, and XYZ, would prepare their own individual standalone financial statements. But for the purposes of consolidated reporting, we combine them.
Would you just pull them together?
Exactly. You literally consolidate the financial statements of parent MNO Ltd. with those of its subsidiaries ABC Ltd. And XYZ Ltd. The end result is the consolidated financial statements of the entire MNO group.
Okay.
In this typical setup, MNO Ltd's auditor, let's call them SS Maheshwari & Co., would be designated as the principal
Or
auditor,
main auditor.
responsible for expressing an opinion on these consolidated statements. Meanwhile, RT and Associates, auditing ABC Ltd. And XYZ Ltd. individually, will be considered the component auditors.
Component auditors, right.
This structure clarifies that while individual entities have their own audits, the consolidated statement requires an overarching principal auditor.
Makes sense.
It's also crucial to remember that the parent company's management holds the primary responsibility for preparing these consolidated financial statements after the individual entities have prepared and, if required, had their standalone statements audited.
That paints a very clear picture. So this consolidation, is it just a nice to have for transparency, or is it a mandatory requirement for companies operating in India?
That raises a critical point, and it's a definite exam favorite. According to Section 129 of Companies Act 2013, it is indeed mandatory.
Mandatory, okay.
Where a company has one or more subsidiaries, and for this purpose, subsidiary here broadly includes associate companies and joint ventures, which is an important detail. It shall prepare consolidated financial statements in addition to its own standalone financial statements.
So associates and JVs count too.
Yes, that's key. These must be prepared in the same form and manner as standalone statements. Furthermore, Section 129.4 reinforces this by stating that provisions applicable to standalone financial statements, such as those related to their preparation, adoption by shareholders, and audit, apply mutatis mutandis to CFS.
Mutatis mutandis, Latin, right.
Right, it just means with necessary changes. So the same rules and principles largely hold true for consolidated statements.
Okay.
For your exam, be precise. CFS must include a consolidated balance sheet, a consolidated statement of profit and loss, a consolidated cash flow statement, a consolidated statement of change in equity, if applicable, and all necessary explanatory notes.
The whole set.
The whole set. The formats for these are prescribed under Schedule 3 of the Companies Act, 2013, and the fundamental principles and procedures are laid down by Accounting Standards AS 21, or for companies following IND AS, Indian Accounting Standard, IND AS 110.
IND AS 110, that's the big one for IND AS then.
Exactly. Understanding these specific standards is key to your success.
That's a very strong legal mandate. But given the complexities, are there any situations where a company with subsidiaries might be granted an exemption from this rigorous requirement? For instance, what if a subsidiary is acquired with the clear intent to sell it off quickly, perhaps within a year?
Yes, there are specific exemptions, but they are very narrowly defined, and you must pay close attention to all the conditions as they are cumulative.
All of them, not just one.
All of them. The requirement to prepare CFS shall not apply if a company meets all of the following conditions. First, it must be either a wholly owned subsidiary, or if it's a partially owned subsidiary, all its other members must have been formally intimated in writing about the company's decision not to present consolidated financial statements, and they must not have objected.
Okay, written proof needed.
Right. Proof of this intimation and non-objection needs to be available. Second, its securities are not listed, nor are they in the process of being listed on any stock exchange, whether in India or outside India.
So private companies mainly.
Generally, yes. And third, its ultimate or any intermediate holding company files consolidated financial statements with the registrar that fully comply with the applicable accounting standards.
So consolidation happens higher up the chain.
Precisely. It's critical to remember that all three of these conditions must be met for the exemption to apply. It's not in any one situation.
Got it. All three.
Now, in addition to these, IND AS 110 introduces another specific exemption. It allows for an exemption if the company is an investment entity.
An investment entity, what's that exactly?
It is a very specific definition. It obtains funds from one or more investors for the purpose of providing them with investment management services.
Okay.
It commits to its investors that its business purpose is to invest funds solely for capital appreciation or investment income.
Right.
And it measures and evaluates the performance of substantially all its investments on a fair value basis.
Fair value. Okay, so specific criteria there too.
Very specific. Now, this brings us directly to a common and crucial exam-style scenario, which ties into your question about temporary control.
Ah, yes. The sell it quick scenario.
Exactly. Your study material describes a situation where Parent Ltd. Acquired 51% shares of Child Ltd. And sold 20% in the next year, but didn't consolidate, arguing temporary control.
Right. I remember seeing that.
For your exam, remember this absolute rule. NAS 110 has no exemption for temporary control or severe long-term funds transfer restrictions.
None at all.
None. Consolidation is mandatory from the precise date control is obtained until it ceases. This is a prime example of accounting prioritizing substance over form.
Substance over form.
Okay, even if a parent company plans to sell a subsidiary quickly, the moment they gain control, that subsidiary becomes part of the economic entity. The rules compel a truly holistic view, preventing companies from strategically excluding entities to present a more favorable but ultimately incomplete picture.
So that argument about temporary control just doesn't fly under NAS 110.
Doesn't fly at all. In that specific scenario, Parent Ltd. was indeed required to consolidate. This is a vital distinction to grasp at a very common trap in exam questions. You must know that even if the intent is to dispose of it quickly, it still needs to be consolidated for the period control exists.
So if consolidation is mandatory and these rules are so specific, who's ultimately on the hook for making sure these consolidated financial statements are prepared correctly? Is it primarily the auditor who swoops in, or does the parent company's management play an even more significant role?
Well, the primary responsibility for the preparation and accurate presentation of consolidated financial statements rests squarely with the management of the parent company.
The parent's management.
Okay.
This isn't just a technical accounting exercise, it's a strategic and operational one that demands a thorough understanding of the group structure. Their responsibilities are extensive, covering several key areas.
Like what, for instance?
Okay, first, they are responsible for identifying all components within the group and ensuring that their complete financial information is included in the consolidation. Makes sense. Find all the pieces.
Exactly. Second, where applicable, they must accurately identify reportable segments for segmental reporting, which provides crucial insights into different parts of the business.
Segment reporting, right.
Third, identifying related parties and all related party transactions is their duty, ensuring these are properly disclosed.
Always a tricky area.
Indeed. Fourth, they are charged with obtaining accurate and complete financial information from all components within the group, which can be a significant logistical challenge, especially for global operations.
I can imagine.
Fifth, they are responsible for making all the appropriate consolidation adjustments, which we'll definitely discuss in more detail later.
Okay.
Sixth, a critical responsibility is harmonizing accounting policies and ensuring a consistent accounting framework across the entire group. This often means aligning diverse practices from different legal entities.
Getting everyone on the same page, policy-wise?
Precisely. And finally, if necessary, they must perform GAAP conversion for foreign components whose local generally accepted accounting principles, GAAP, differ from the group's reporting framework.
GAAP conversion, right.
They even go so far as to issue specific instructions to components regarding accounting policies to be applied, statutory and other disclosure requirements, including reporting on reportable segments and related parties, and a strict reporting timetable to ensure timely consolidation.
Wow, so they're really orchestrating the whole thing.
They absolutely are.
That makes perfect sense. The parent has the overall view, the strategic oversight. But I'm curious, does that mean the auditor just takes their word for it? Or is there a specific independent check the auditor absolutely must perform to ensure the parent's management has indeed fulfilled that responsibility? What's their specific responsibility when auditing these consolidated statements?
That's a crucial distinction. The principal auditor's role is indeed critical and independent. Section 129 of 4 of the Companies Act, 2013, as we discussed, mandates that audit provisions applicable to standalone financial statements apply mutatis mutandis, meaning with necessary changes to CFS.
Right, with necessary changes.
So the principal auditor is fundamentally responsible for expressing an opinion on whether the consolidated financial statements are prepared, in all material respects, in accordance with the applicable financial reporting framework.
Giving that true and fair view opinion.
Exactly. This includes reporting on additional matters as required by the Companies Act, 2013, and other relevant statutes. To be more precise about the auditor's objectives in a group audit, they are multifaceted.
Okay, what are they?
Firstly, they must satisfy themselves that the CFS are prepared accurately and fairly, according to the prescribed financial reporting framework. Secondly, they aim to express an opinion on whether the CFS present a true and fair view of the group's financial position and performance.
The core opinion.
The core opinion. Thirdly, they are required to inquire into specific matters as laid out in Section 143 of the Companies Act, 2013, just as they would for standalone statements.
Standard procedures there.
Yes. And fourthly, they must report on matters stipulated in Section 143(3)(a)(2)(i) and Rule 11 of the Companies Audit and Auditors Rules, 2014, covering various other critical aspects.
So specific reporting points, too.
Absolutely. Crucially, beyond auditing the numbers, the auditor also has a responsibility to validate the requirement for CFS preparation itself as per the applicable financial reporting framework, ensuring the company is indeed subject to this mandate.
So they check if consolidation is even required in the first place.
They have to. For your exam, it's vital to remember that all standards on auditing, ACS, along with statements and guidance notes on auditing matters issued by the ICAI, apply to CFS audits in the exact same rigorous way they apply to standalone audits.
Same SS play.
Okay.
Same SS. This means the principal auditor must effectively plan their work, obtain a deep understanding of both the accounting and internal control systems. And this absolutely includes understanding the specific IT tools or consolidation software used by the group sufficiently to plan the audit.
Understanding the IT is key nowadays.
Crucial. They must also use professional judgment to assess audit risk and design audit procedures to ensure that this risk is reduced to an acceptable level. This foundational understanding of audit principles applied within the group context is key to tackling any scenario you'll face.
All right, so we've mapped out what CFS are and who's responsible for them. Now let's peel back another layer and get into the really practical side. What does an auditor actually consider when they're auditing these consolidated statements, getting into the nitty-gritty of the process?
This is where the detailed audit procedures really come into play. Firstly, it's fundamental to recognize that consolidated financial statements are constructed from two primary sources: the separate financial statements of the parent and each of its components.
Right, the building blocks. Plus, other financial information that might not appear in those standalone statements.
Other info, like what?
This other information includes crucial items like disclosures on differing accounting policies across the group or adjustments for post-balance sheet events specific to the consolidated view.
Ah, okay. Stuff that only makes sense at the group level.
Exactly. The principal auditor's initial assessment is whether their own work, combined with this information, is sufficient to form an opinion on the consolidated statements.
Can they do enough themselves?
That's the question. And this is precisely where it gets really interesting and leads us to a critical standard on auditing. If the principal auditor concludes that their direct participation in the audit isn't sufficient to form an opinion on the group financial statements alone,
Right.
then they must consider utilizing the work of other auditors.
Okay, the component auditors we mentioned earlier.
Precisely. This brings us directly to Standard on Auditing SA 600, titled Using the Work of Another Auditor. This essay is absolutely crucial for situations where the principal auditor relies on the audit work performed by others for components of the group, which is a very common occurrence in complex corporate structures.
SA 600. Got it. That sounds important for the exam.
Very important.
Yeah.
Now let's talk about materiality in this context, because it's calculated differently for group audits.
How so?
Materiality is computed for the group as a whole. This overarching group materiality figure is then used to assess the appropriateness and impact of all consolidation adjustments, both permanent and current period adjustments, on the overall consolidated financial statements.
So one big materiality number for the whole group.
Initially, yes. Furthermore, the principal auditor will also compute specific materiality levels for each component where they deem it necessary.
Okay, component level 2.
And this component-specific materiality is then communicated to the respective component auditor.
So everyone knows the threshold.
Exactly. Any observations or modifications in a component auditor's report, such as a qualified opinion or a disclaimer under SA 705, or an emphasis of matter or other matter paragraph under SA 706, must be carefully considered by the principal auditor under the principles of SA 600, always factoring in the established materiality levels.
Right, to see if it affects the group opinion.
Precisely. This ensures that any significant issues at the component level are properly reflected, if material, at the group level.
So it sounds like planning for a group audit must be incredibly rigorous and comprehensive. What does that planning look like for a principal auditor? What are the key areas they need to strategize around before even beginning the field work?
Planning is indeed paramount, almost a strategic blueprint. Before even embarking on the audit, the principal auditor must meticulously plan across several key areas.
Okay, what are they?
First, they need to develop a thorough understanding of the group's overall structure and assess the group-wide controls, which includes critically evaluating the information technology IT system and related general and application IT controls, both manual and automated, that underpin the entire consolidation process.
Understand the structure, the controls, the IT.
Yes. Second, they need to gain a deep understanding of the accounting policies adopted by all entities within the group, and a detailed grasp of the consolidation process itself, including the inherent complexities of translating financial statements of foreign components.
Policies, process, foreign currency. Check.
Third, based on their risk assessment of material misstatement in the consolidation process, they must determine and program the precise nature, timing, and extent of the audit procedures that need to be performed.
Nature, timing, extent. The core audit planning.
Exactly. Fourth, a major part of the planning involves deciding the precise extent of reliance they will place on the work of other auditors, which directly links back to SA 600.
How much to rely on others. Okay.
And finally, they must ensure effective coordination of all the audit work to be performed across the entire group, often involving multiple audit teams across different geographies, to ensure both efficiency and effectiveness in achieving the overall audit objective.
Coordination is key, especially with multiple teams.
Absolutely essential.
That's a massive undertaking. And a core part of that must be ensuring that all the right companies, all the right components are actually included in the consolidated financial statements. How does an auditor verify the completeness of components? What procedures are involved there?
Absolutely. Completeness is foundational. If a component is missing, the entire picture is distorted. The principal auditor's first step is to obtain a comprehensive listing of all components included in the consolidated financial statements,
We have the list.
and critically review the information provided by the parent company's management that identifies these components. The auditor's procedures to verify this completeness are quite extensive.
Like what kind of procedures?
Well, they will review their working papers from prior years to identify previously known components and verify their continued inclusion.
Check last year's files. Makes sense.
They'll scrutinize the parent's own internal procedures and controls for identifying various components.
Yeah.
How do they track acquisitions, new subsidiaries, or disposals?
Look at the parent system.
Right. They make direct inquiries of management to identify any newly acquired components or any component that has ceased to be part of the consolidated group during the period.
Ask management directly.
They also meticulously review the investments of the parent company, as well as its existing components, to determine the shareholding in other entities. This helps uncover entities that might have been overlooked.
Check the investment register.
Yes. Furthermore, they review joint ventures, joint arrangements, and any other similar arrangements entered into by the parent that might not yet have been included in the group's consolidated financial statements.
JVs and other arrangements too.
A vital step is reviewing statutory records maintained by the parent, such as registers under Section 186, Loans and Investment by Company, and Section 190, Register of Contracts or Arrangements in which directors are interested, of the Companies Act, 2013.
Check the legal records.
These legal records can highlight undisclosed interests. They also meticulously identify any changes in shareholding that might have taken place during the reporting period, as these changes can trigger or cease consolidation requirements.
Track shareholding changes.
And throughout this, the auditor must meticulously document all the procedures performed for assessing the completeness of the components to be consolidated.
Document everything, of course.
It's important to understand that control, joint control, or significant influence can be obtained through various means, not just majority shareholding.
Right, not just owning over 50%.
Exactly. So the auditor will also verify the board's minutes, shareholder agreements entered into by the parent, agreements with entities to which the parent might have provided any technology or know-how, or even the enforcement of statute, as these can be indicators of control.
Look beyond the shares.
Yes. They may also review the minutes of the meetings of the board of directors subsequent to the year-end to understand if there has been any liquidation of investments or if any further investments have been made.
Check post-year-end events, too.
This can provide further evidence to ascertain if the control was truly temporary in nature or if a more permanent relationship has been established, a distinction we discussed earlier as being crucial for your exam.
That's a very thorough process for completeness. But what happens if, despite all these rules and procedures, a component is excluded from consolidation? How does the auditor deal with that, and what are the implications?
This is a critical area, especially for exam scenarios. The auditor must meticulously examine the reasons for any exclusion and verify that they conform strictly with the applicable financial reporting framework.
Check the reason against the rules.
Right. For example, under the Company's Accounting Standards Rules, 2006, certain exclusions could be allowed for genuinely temporary relationships or severe long-term restrictions on the transfer of funds. However, and this is a key differentiator for your exam, for IND AS 110, as we firmly established, temporary is generally not an allowed exclusion unless the entity falls under the very specific definition of an investment entity.
So in AS 110 is much stricter on exclusions.
Much stricter. So if management argues for exclusion on temporary grounds, the auditor must verify that the parent's intention to dispose of the subsidiary, investment in associate, or interest in jointly controlled entity existed at the time of acquisition, not just later.
Check the intention at acquisition.
Yes. The auditor should also verify that the reasons for exclusion, if permissible, are clearly and adequately disclosed in the consolidated financial statements.
Disclosure is key.
Always. Crucially, if an entity is excluded from the consolidated financial statements for reasons other than those explicitly allowed by the applicable financial reporting framework, the auditor must consider the effect of this on their auditor's report.
Uh-oh. Impact on the audit report.
Potentially, yes. This could lead to a modification of their opinion, highlighting a material misstatement.
A qualified opinion, maybe.
Or worse, depending on materiality. Furthermore, the auditor must also examine any changes in the status of a component. For instance, if a subsidiary loses control and becomes just an associate, and ensure these changes are appropriately accounted for in the consolidated financial statements as required by the relevant accounting standards or IND AS.
Track changes in status, too. Subsidiary to associate, etc.
Exactly. This vigilance ensures the consolidated statements always reflect the true economic relationship.
Okay, so once all the right components are identified and correctly included, then comes the actual combining of their financials. I understand there are different types of adjustments that need to be made to bring everything together. Can you walk us through the permanent and current period adjustments? What makes them different?
Yes, these adjustments are truly the heart of the consolidation process, where the individual financial statements are woven into a single, cohesive group picture. Let's start with permanent consolidation adjustment.
Permanent ones first. Okay.
The key characteristic here is that these adjustments are made only on the first occasion of consolidation. That is, when a company first becomes part of the group, or when there's a significant structural change, such as a change in shareholding of a particular consolidated entity that alters the degree of control.
So first time in or big ownership changes.
Exactly. They're essentially one-off adjustments that establish the group's initial financial position post-acquisition or reflect a fundamental shift in control.
Setting the baseline.
Precisely. There are two primary types of permanent adjustments you should focus on for your exam.
Okay, what are they?
First, the determination of goodwill or capital reserve. This arises from the difference between the acquisition price paid by the parent and the fair value of the net assets acquired from the subsidiary.
Price paid versus fair value of what you got.
Right. If the price paid exceeds the fair value of net assets, you have goodwill. If it's less, you have a capital reserve. The auditor pays particular attention to correctly identifying the subsidiary's pre-acquisition reserves and meticulously verifying the exact date of investment,
Pre-acquisition reserves and dates are key.
as these dates dictate what portion of the subsidiary's equity belongs to the parent and what becomes part of the acquisition calculation. Second, the determination of equity attributable to minority or non-controlling interests.
NCI, right. Non-controlling interest.
Exactly, NCI. This represents the portion of the subsidiary's equity that is not owned by the parent company. The auditor must ensure that the pre-acquisition reserves of the subsidiary are appropriately allocated between the parent's interest and the non-controlling interests.
Split the pre-acquisition equity correctly.
You got it. To give you a concrete example from your source, think of XYZ Ltd. reducing its control over ABC Ltd. from 70% to 55%.
Okay. Selling down some shares, but still controlling.
Right. The adjustments made to reflect this change in shareholding, including any remeasurement of remaining interest, would be classified as permanent consolidation adjustments because they reflect a fundamental change in the ownership structure.
Because the ownership percentage changed significantly.
Correct. The auditor also meticulously verifies if goodwill and capital reserves arising from various subsidiaries are appropriately netted off as per accounting standards and, where permitted, ensures that their gross amounts are appropriately disclosed in the notes to the consolidated financial statements, reflecting the excess or shortage over the parent's portion of the subsidiary's equity. This attention to detail is crucial for exam success.
That clarifies the permanent ones. So they're about setting the initial stage or reflecting a big structural shift. What then are current period consolidation adjustments? How are they different? And what's their purpose?
Current period adjustments are exactly what they sound like. Those adjustments that are made in the current accounting period for which the consolidation is being performed.
Done every year then?
Generally, yes. Unlike permanent adjustments, these are typically recurring adjustments, and their core purpose is to present the group as a single economic entity by eliminating transactions and balances within the group.
Eliminating the internal stuff.
Exactly. Think of it like this. If one part of your body, a subsidiary, sells something to another part of your body, the parent, that's not a true external sale for the whole you, the group. These adjustments remove that internal noise from intercompany dealings so that you're only seeing the group's external transactions and true overall financial position.
Removing the noise. I like that. What are some examples?
Okay, key current period adjustments you'll encounter and should be prepared for include, Firstly, the elimination of intra-group transactions and account balances.
Like intercompany sales.
Yes, exactly. Wiping out things like intercompany interest paid and received,
Yeah.
management fees charged between group entities, or intercompany sales and purchases.
Hmm.
These are internal transfers, not external revenues or expenses for the group.
Got it.
Secondly, the elimination of unrealized intragroup profits on assets acquired or transferred.
Unrealized profits.
Yeah.
So profit on stuff still within the group.
Precisely. If one subsidiary sells inventory to another at a profit, but that inventory hasn't been sold outside the group yet, that profit is unrealized from the group's perspective and must be eliminated.
Makes sense. It hasn't really been earned by the group yet.
Right. And crucially, this also involves recording related deferred taxes on these eliminations in accordance with NDS 12.
Deferred tax implications do. Okay.
Thirdly, the elimination of intragroup indebtedness. This means removing any loans or payables receivables between group entities.
Parent owes sub money. Cancel it out.
Cancel it out on the consolidated balance sheet. Fourth, adjustments to harmonize differing accounting policies. If different entities within the group follow slightly different accounting policies, these must be made consistent.
Aligning policies, like depreciation methods.
Exactly. Or converting a foreign component's local GAAP statements to the group's GAAP. Fifth, adjustments for subsequent events or transactions.
Events after the balance sheet date.
Right, especially if component financial statements aren't drawn up to the exact same date as the parent. These can be adjusting events or non-adjusting events, and disclosure is crucial for the non-adjusting ones.
Okay.
Sixth, for foreign components, adjustments to convert their audited financial statements prepared under their local GAAP to the GAAP under which the consolidated financial statements are prepared.
That gap conversion again.
Yes. Seventh, determination of movement in equity attributable to the non-controlling interest since the date of acquisition. And notably, under NAS, NCI can even result in a negative balance.
Negative NCI.
Yes, unlike under older standards. And finally, adjustments of deferred tax on account of temporary differences arising out of elimination of profit and losses resulting from intergroup transactions and undistributed profits of components, especially under NAS.
More deferred tax. Seems
Yeah.
important.
Very important. The auditor's procedures for these current period adjustments involve meticulously reviewing the memorandum records where these adjustments are made. They must verify that all intragroup transactions and balances are completely eliminated.
Check the elimination.
Ensure uniform accounting policies are applied or disclosed if impracticable, and perform critical verification of the calculations for NCI and deferred tax. Understanding management's procedures is also key.
One more thing you mentioned was goodwill impairment. Is that current period?
Yes, an important current period adjustment is the determination of impairment loss for goodwill arising on consolidation. The auditor carefully examines management's procedure for determining this impairment, ensuring it's fair and compliant.
Check if the goodwill value has dropped.
Essentially, yes. If it's for a foreign component, they'll verify currency translation reserve adjustments. They also look for intragroup losses that might indicate impairment. This ensures the goodwill on the balance sheet isn't overstated.
That's a comprehensive list of current period adjustments. You touched on it briefly, but what about differing reporting dates for components? How does the auditor handle that challenge, especially for global groups where aligning fiscal years might be impractical?
That's a very real-world challenge. The ideal scenario, of course, is that all components' financial statements are drawn up to the exact same reporting date as the parent.
But that often doesn't happen, right?
Often not practicable, especially globally. So, if it's genuinely not practicable, then adjustments must be made for the effects of significant transactions or other events that occur between the component's balance sheet date and the parent's balance sheet date.
Adjust for the gap period.
Right. Critically, the difference between these reporting days should not exceed 6 months under accounting standards, AS. Or, for companies following NAS, it must not exceed 3 months.
3 months max under NDAS. That's stricter.
It is. The auditor of the consolidated financial statements has a duty to review the component's results within that intervening period, say, between December 31st and March 31st.
Look at what happened in that gap.
Exactly. They specifically look for significant transactions or other events during this period that need to be reflected or disclosed in the consolidated statements. This vigilance helps maintain the fundamental accounting assumption of consistency.
Ensure the gap doesn't distort the picture.
Precisely. If there have been material changes in this intervening period that could impact the group's true and fair view, the auditor ensures appropriate disclosure is made.
And what about disclosures themselves? Are consolidated financial statements expected to merely repeat everything from the separate standalone statements, or is there a different approach?
No, absolutely not. This is a common misconception and a point often tested. The Ministry of Corporate Affairs, MCA Circular 392012, explicitly states that consolidated financial statements should not merely repeat disclosures from separate financial
They don't
statements.
just copy-paste the notes.
Exactly. Instead, only disclosures relevant to the consolidated financial statement should be given as an integral part thereof. This means a focus on the group as a whole.
Group-level relevance. Okay.
For your exam, be aware of what is required and what generally is not. What is required includes specific information like the amount of net assets for the parent and each consolidated component, and this amount expressed as a percentage of consolidated net assets.
Net assets and percentage.
Similarly, the amount of share in profit or loss for each component, and that amount as a percentage of consolidated profit or loss.
Profit, loss, and percentage.
And for Indocast compliant companies, the amount in other comprehensive income, OCI, like revaluation surpluses or currency translation differences, along with the percentage of OCI as a percentage of consolidated OCI, all separately presented for the parent and each component.
OCI and percentage, too,
Right.
for Ind AS.
Yes. On the flip side, examples of detailed information generally not required to be repeated in CFS notes include the source of bonus shares, details of unutilized funds, extensive MSME disclosures, highly detailed investment statements, less specific to group view, granular import-export values, and overly detailed foreign currency expenditure earnings details for individual components.
So less granular detail, more group overview.
Generally, yes. However, notwithstanding this guidance, the auditor must always ensure overall compliance with the disclosure requirements of applicable accounting standards and other laws that specifically govern consolidated financial statements.
Still need to comply with the main standards, of course.
Absolutely.
Finally, what kind of critical representations does the auditor need to obtain from management regarding all these complex adjustments and the overall CFS? These written representations are crucial for audit evidence, aren't they?
They absolutely are. Under Standard on Auditing, SA 580, written representations, the auditor obtains specific written representations from management.
SA 580, management reps.
Right. For CFS, this includes management acknowledging its fundamental responsibility for the true and fair presentation of the consolidated financial statements in accordance with the applicable financial reporting framework, and confirming that the parent management has formally approved the CFS.
Management takes responsibility and approves.
Yes. In addition, the auditor obtains specific written representations on matters that are material to the consolidated financial statements.
Like what specific things for CFS?
Examples include management's confirmation on the completeness of all components included in the CFS, the proper identification of reportable segments, the accurate identification of related parties and related party transactions, and crucially, management's assertion on the appropriateness and completeness of all permanent and current period consolidation adjustments, including the elimination of all intergroup transactions and balances.
Confirming completeness, segments, related parties, and the adjustments themselves.
Exactly. These representations serve as vital audit evidence, confirming management's assertions and their ultimate responsibility for the accuracy of the consolidated picture.
This section is a big one, often a major area of focus for complex audits. When a principal auditor relies on the work of another auditor for components, it's governed by SA 600, using the work of another auditor. Can you walk us through the critical aspects of this standard, especially as it relates to group audits?
Certainly. SA 600 is indeed pivotal for group audits, as it establishes the standards and provides guidance for situations where an auditor, the principal auditor, decides to use the work performed by an other auditor who has reported on the financial information of a component.
Principal auditor, other auditor, component, got the terms.
Right. A component here is broadly defined. It can be a division, branch, subsidiary, joint venture, associated enterprise, or any other entity whose financial information is included in the larger financial information being audited by the principal auditor.
Okay, pretty broad definition.
Yes. Now, before even accepting the engagement as the principal auditor, the auditor must perform a critical self-assessment. Is their own participation in the audit sufficient to enable them to act in this capacity?
Can I actually be the principal auditor here?
That's the question they have to ask. They consider several factors. Firstly, the materiality of the portion of the financial information that the principal auditor themselves will audit directly.
How much am I auditing myself?
Right. Secondly, their degree of knowledge regarding the business operations of the components.
Do I understand these other businesses?
Thirdly, the risk of material misstatements in the financial information of the components that will be audited by the other auditor.
How risky are the parts I'm not auditing directly?
And fourthly, whether they can perform sufficient additional procedures, as set out in SA 600, regarding the components audited by other auditors. The goal is to ensure that the principal auditor retains significant participation in such an audit to justify their overall opinion.
Can I do enough extra work to be comfortable? Makes sense.
This initial assessment is foundational.
Once they've accepted the role, knowing they'll rely on others, what specific procedures does the principal auditor perform concerning that other auditor to ensure they can confidently rely on their work?
Okay, so even if the statute governing the entity confers a right on the principal auditor to visit a component and examine its books, which it sometimes does, the principal auditor is generally entitled to rely on the other auditor's work.
They can rely by default.
Generally, yes. This reliance holds true unless there are special circumstances that should reasonably arouse suspicion about the reliability or quality of the work performed by the other auditors. So the burden of proof is on the principal auditor to identify issues rather than automatically distrusting.
Innocent until proven otherwise? Sort of.
You could say that. Now, the key procedures the principal auditor should ordinarily perform include: first, critically assessing the professional competence of the other auditor in the context of the specific assignment.
Are they competent?
Especially important if the other auditor is not a member of the ICAI, maybe a foreign auditor.
Right. Check their qualification.
Second, to obtain sufficient appropriate audit evidence, they must advise the other auditor on how their work and report will be used in the consolidated financial statements. They also make sufficient arrangements for coordination of their efforts at the planning stage.
Tell them how their work fits in. Coordinate early.
Yes, this involves clearly communicating matters such as areas requiring special audit consideration, procedures for identifying significant intercomponent transactions, and agreeing upon the overall timetable.
Set the ground rules and deadlines.
Exactly. Third, they advise the other auditor of the significant accounting, auditing, and reporting requirements relevant to the group and obtain formal representations from them as to their compliance.
Make sure they know the rules and confirm they'll follow them.
Correct. The principal auditor might, and often does, discuss the specific audit procedures applied by the other auditor or review a written summary of their procedures and findings.
Discuss procedures, review summaries.
This summary might be in the form of a completed questionnaire or checklist. They may even wish to visit the other auditor's office to review their work, depending on the risk and prior knowledge.
Visit them potentially.
Potentially. The nature, timing, and extent depend on circumstances and their knowledge of the other auditor. The principal auditor should also carefully consider the other auditor's significant findings and discuss them.
Discuss significant findings.
Yes. They might discuss audit findings or other matters with the other auditor and component management. Based on this, they might even decide that supplemental tests are necessary, performed by either auditor.
Might need extra tests.
Might need them. A crucial point for your exam: if the other auditor happens to be a person other than a professionally qualified auditor like in a foreign country, these procedures assume even greater importance and stringency.
Extra checks if they aren't a qualified auditor. Got it. That sounds like a lot of coordination and oversight. How does the principal auditor formally document all this reliance and the work performed by these other auditors? Documentation is always key in auditing, isn't it?
Documentation is absolutely key here, and it's a critical component of demonstrating compliance with SA 600. The principal auditor must meticulously document several specific aspects.
Okay, what needs documenting?
Firstly, they document the components whose financial information was audited by other auditors, clearly stating their significance to the financial information of the entity as a whole.
Which components? How significant?
Secondly, they list the names of the other auditors involved.
Who did the work?
Thirdly, they document any conclusions reached that individual components are not material to the consolidated financial statements, justifying why their audit work might be less extensive.
Justify if something's immaterial.
And most importantly, the principal auditor must document the procedures performed in relation to the work of the other auditors and the conclusions reached from those procedures.
What did I do? What did I find?
Exactly. For example, they would document the results of their discussions, their review of summaries. If the other auditor's report is anything other than unmodified, meaning it has issues, the principal auditor should document precisely how they dealt with these issues in framing their own report.
Document how modifications were handled.
Yes, this thorough documentation provides the necessary audit trail and justification for their ultimate opinion.
Building on that, what are the direct expectations for coordination and liaison between the principal auditor and the other auditors? It sounds like an orchestra needs a conductor.
It's an excellent analogy, a conductor ensuring all instruments are in harmony. There must be sufficient liaison between the principal auditor and the other auditor.
Has to be good communication.
Absolutely. For this purpose, the principal auditor will often find it necessary to issue formal written communications to the other auditor, setting out expectations.
Put it in writing.
Yes. The other auditor, being aware of the context in which their work is to be used, has a responsibility to coordinate effectively. For example, they do this by promptly bringing any significant entity-level findings to the principal auditor's immediate attention,
Flag major issues quickly.
by adhering strictly to the agreed-upon timetable,
Meet the deadlines.
and by ensuring full compliance with all relevant statutory requirements applicable to their component audit.
Follow the rules.
Similarly, the principal auditor should proactively advise the other auditor of any matters that come to their attention that they believe may have an important bearing on the other auditor's work.
Two-way street for communication.
Crucial. When considered necessary, the principal auditor may also require the other auditor to answer a detailed questionnaire regarding specific matters,
Might send a questionnaire.
and the other auditor is expected to respond diligently and timely. This structured coordination minimizes surprises and ensures a consistent approach.
This coordination sounds vital. But what are the reporting implications if, despite all these efforts, the principal auditor can't use the other auditor's work? Or if the components auditor issues a modified report? How does that impact the principal auditor's opinion on the consolidated financial statements?
This is where the audit opinion can be significantly affected, and it's a critical area for your exam. If the principal auditor concludes, based on their procedures, that the work of the other auditor cannot be relied upon or used,
Can't rely on them.
and they have not been able to perform sufficient additional procedures regarding the financial information of that component,
And can't do enough extra work.
then the principal auditor faces a scope limitation. In such a scenario, they should express a qualified opinion or even a disclaimer of opinion on the consolidated financial statements.
Qualification or disclaimer due to scope limit.
Exactly, because they haven't been able to obtain sufficient appropriate audit evidence. Furthermore, in all circumstances, if the other auditor issues, or intends to issue, a modified auditor's report on their component's financial statements,
If the component report is modified,
the principal auditor must carefully consider whether the subject of that modification is of such a nature and significance in relation to the financial information of the entity as a whole that it requires a corresponding modification of the principal auditor's own report.
does the component issue affect the whole group materially?
That's the key question. It's about materiality at the group level. Now, SA 600 also explicitly addresses the division of responsibility.
Division of responsibility.
Yes, the principal auditor is not inherently responsible for the work directly entrusted to the other auditors.
Okay, not automatically responsible.
This principle holds true unless specific circumstances should have reasonably aroused their suspicion about the reliability of the work. When the principal auditor bases their opinion on the financial information of the entity as a whole, relying upon the statements and reports of the other auditors, their report should clearly state the division of responsibility
How does he state that?
by indicating the magnitude of the portion of the financial statements audited by the other auditor. This can be presented by stating aggregate rupee amounts or percentages of total assets, revenues, and cash flows of components included in the consolidated statements that were not audited by them.
Show the size of the part audited by others?
And this is done before giving effect to any consolidation adjustments. This reference in the report is important. It is not a qualification. It's an indication of divided responsibility, clearly informing the users.
Not a qualification, just explaining who did what. Got it. What if some components use different accounting or auditing frameworks? This must be a common issue, especially with international groups. How does the auditor navigate these differences?
That's a very perceptive question, as it is indeed a common scenario, particularly with multinational groups. For accounting framework differences, foreign components might prepare their financials using local GAAP-like US GAAP or IFRS, which could differ from the parent's framework, say IND AS.
Different accounting rules.
Right. In such cases, the parent's management is responsible for performing a conversion of these components' audited financial statements from their local GAAP to the GAAP under which the consolidated statements are prepared.
Management does the conversion.
And the principal auditor then audits these conversion adjustments to ensure the financial information is suitable and consistent for consolidation.
Auditor checks the conversion adjustments.
Okay. Alternatively, components might prepare their financial statements directly under group accounting policies, designed to be consistent with the parent's GAAP, often from a group manual.
Use a group policy manual.
In this scenario, the principal auditor then verifies the consistent application and compliance of these group policies by the component.
Check they followed the group manual.
Now, for auditing framework differences, the goal is consistency and reliability. Ideally, components audits should align with Indian GAS to enable robust reliance and reference.
Ideally, use Indian auditing standards.
Ideally. If the component auditor reports under a different auditing framework, the principal auditor needs to undertake additional procedures to ensure that the work performed is adequate for their purposes.
More work needed if auditing standards differ.
Yes. This often involves a deeper review of the other auditor's work papers or more extensive discussions to confirm the quality and scope meet the requirements for reliance under Indian GAS.
And finally, a very serious hypothetical. What happens if some components simply aren't audited at all? Is that even permissible in a consolidated financial statement context?
This is indeed a serious matter, and typically it is not permissible. Generally, the financial statements of all components included in consolidated financial statements should be audited, or at least subjected to equivalent audit procedures.
Everything should be audited, really.
Or have equivalent procedures performed, yes. Such audits or procedures can be performed either by the principal auditor or by the respective components auditors. However, where the financial statements of one or more components remain unaudited, and this would be an exceptional and highly problematic situation, the auditor reporting on the consolidated financial statements must evaluate both qualitative and quantitative factors for a possible modification to their report.
Unaudited components mean potential report modification.
Absolutely. They would use SA 705, modifications to the opinion, to do so. This evaluation is necessary because the auditor hasn't been able to obtain sufficient appropriate audit evidence in relation to those significant consolidated amounts.
Another scope limitation, essentially.
Exactly. This lack of evidence represents a material limitation on the scope of the audit, which must be reflected in the auditor's opinion, potentially leading to a qualified opinion or a disclaimer of opinion. It indicates a fundamental gap in the audit coverage.
This has been an incredibly detailed deep dive into the complex world of group audits. To bring all these intricate pieces together and truly help you prepare for that upcoming exam, let's now walk through an integrated case scenario, much like you might encounter on your exam. It's a fantastic way to apply everything we've discussed.
Excellent idea. Your source material provides an integrated case scenario for YK Industries Limited. Let's break it down point by point, applying all the principles and standards we've meticulously discussed, just as you would in an exam setting.
All right, let's dive into point A of the YK Industries case. The scenario states, the notes to accounts in respect of consolidated financial statements disclose additional information pertaining to the holding company and its subsidiaries. It provides disclosure regarding percentages of consolidated net assets, of consolidated profit and loss, and of total comprehensive income along with their respective amounts pertaining to holding company and its subsidiaries. Is this proper?
Okay, this is a classic exam question testing specific disclosure knowledge based on MCA Circular 392-13 and a very specific example in your source.
Right, the MCA circular.
Consolidated financial statements should only include disclosures relevant to the consolidated statements. Now, disclosing percentages of net assets and P&L with amounts is generally proper and required for IND-AS companies.
So far, so good.
However, the source's designated correct answer highlights a potential issue. The most precise answer given states the disclosure is not proper if the percentage of other comprehensive income, OCI, along with its amount is required but missing.
Ah, the OCI piece might be missing.
Or, furthermore, the source explicitly indicates that consolidated revenue from operations along with its percentage is also required for such disclosure to be fully proper.
Revenue percentage, too.
According to the source's specific requirements, yes. So if either OCI percentage or revenue percentage was omitted, the disclosure wouldn't be considered complete or proper according to those very granular requirements. This level of detail is exactly what your exam expects.
Wow, very specific details matter. Okay, point B. It is noticed by the auditor that financial statements of one foreign subsidiary included in consolidated financial statements are drawn up to December 31st, 2022, in accordance with legal requirements in the U.S. The auditor feels it to be weird and is of the view that consolidated financial statements of the group could present a distorted picture. The management, in turn, informs him that it is not practicable to draw the financial statements of the foreign subsidiary to March 31st, 2023, which is the parent's year end.
Another common practical challenge. The auditor's concern is valid. Consistency is ideal. But management's explanation about impracticality, especially for foreign subsidiaries, is also relevant.
So what's the rule here?
The key is the time difference. Under IND AS, the difference cannot be more than 3 months. Here, December 31st to March 31st is exactly 3 months.
It's within the limit?
It's within the permissible limit. Therefore, the auditor can accept management's version of impracticality.
Okay, they can accept it, but
But accepting it comes with a critical duty. The auditor must verify that appropriate adjustments have been made for the effects of significant transactions or events occurring between those differing dates, Jan 1st to March 31st in this case.
check for adjustments in the gap period. Still crucial.
Absolutely. It shows understanding the nuance, not insisting on perfection, but ensuring material effects are accounted for, preventing distortion.
Next up, point C. During the year 2022-23, goodwill of Rs 50 crore had arisen on account of the acquisition of a subsidiary during the year, and there is no impairment loss as on the balance sheet date. Besides, adjustments have been made in consolidated financial statements with respect to intra-group indebtedness and those related to harmonizing different accounting policies.
This point squarely tests your understanding of classifying consolidation adjustments.
Permanent versus current period, right?
Exactly. Goodwill arising from acquisition is a permanent consolidation adjustment. Remember, one-off at acquisition or significant ownership change.
Goodwill permanent. Got it.
On the other hand, adjustments for intragroup indebtedness, eliminating intercompany loans, and harmonizing different accounting policies are current period consolidation adjustments.
Intragroup debt and policy alignment, current period.
Correct. These are recurring, made in the current period to present the group as one entity. This distinction is absolutely fundamental for your exam.
Now, point D in the YK Industries case. It is noticed by the auditor that one subsidiary was acquired on June 15th, 2022. He is in a dilemma as regards the correctness of consolidation of its financial statements in the group financial statements.
This addresses a core principle: when to start consolidation. Often causes confusion.
Acquired mid-year, what's the rule?
For your exam, the key standard is IND AS 110. It's very clear. Consolidation of an investee shall begin from the date the investor obtains control and cease when the investor loses control.
Start when control is gained.
Precisely. Therefore, the auditor's most appropriate action is to verify that only the income and expenses of the subsidiary are included in the consolidated financial statements from the precise date control was gained, June 15th, 2022.
Only from June 15th onward.
Right. And critically, these inclusions must be based on the amounts of assets and liabilities recognized at that acquisition date. The subsidiary's results are not included for the full financial year.
Not the whole year, just the part after control. Okay. And finally, for the YK Industries case. The auditor is also in the process of finalizing the audit report, including matters to be reported under FASER AURO 2020 in respect of consolidated financial statements. However, he is in a fix in respect of the manner of reporting under SARA 2020 relating to consolidated financial statements.
SARA reporting on CFS. This is different from standalone reporting.
How does SARA apply to consolidated statements?
For consolidated financial statements, a separate, full, clause-by-clause carryover report for the consolidated entity itself is generally not required.
No separate full SARA report.
Generally not. Instead, the most appropriate approach is that the reporting of details of subsidiaries, particularly those in India, together with the specific paragraph numbers of their respective CARO 2020 reports, especially if those reports contain qualifications or adverse remarks, would serve the purpose.
So refer to the subsidiary's ARO reports.
Exactly. The principal auditor integrates the relevant CARO findings from component auditors by reference and specific disclosure within the consolidated audit report, rather than preparing an entirely new EARO report for the CFS. It's about effective summarization and referencing.
That in-depth case study truly brings all the concepts to life, demonstrating how they intertwine in a real audit scenario. To reinforce some other key exam-style applications from your study material, let's quickly hit a few more critical points that often trip up students. First, let's quickly reiterate the mandatory nature of CFS and the very specific conditions for its exemptions.
Absolutely, it bears repeating because it's so fundamental. Remember, Section 119.3 makes CFS mandatory for companies with subsidiaries, associates, and JVs. The exemptions are extremely specific and cumulative. Wholly owned or partially owned with no objections, securities not listed or in process, and ultimate or intermediate holding files compliant CFS.
All three conditions.
All three. And don't forget the distinct IND AS 110 exemption for an investment entity measuring subsidiaries at fair value through P&L. Knowing these precisely is paramount.
And that critical point about temporary control, can you hit that one more time? It seems to be a real exam pitfall.
It absolutely is a common exam pitfall. Under IND AS 110, temporary control is unequivocally not an exemption from consolidation, nor are severe long-term funds transfer restrictions.
No temporary control exemption in N8 110, period.
Period. Substance over form. The auditor must challenge any claim to exclude on these grounds. Consolidation starts with control, ends when control is lost. Intent to sell doesn't override the requirement while control exists.
What about those more subtle situations where a parent doesn't have majority voting rights but still exerts control? What's known as de facto control.
De facto control. Nuanced, but vital. It means having the practical ability to direct relevant activities unilaterally, even with less than majority voting rights.
Control without majority shares. How do you check that?
The auditor must diligently verify the basis. Review board minutes showing voting patterns, shareholder agreements granting specific powers, tech transfer agreements, even statutory enforcement that grants significant influence.
Look for the practical power.
Exactly. Confirm the basis for asserting control is sound, justifiable, verifiable, reflecting economic reality.
And when a principal auditor accepts a group audit engagement, knowing they might rely on others, what were those key initial considerations we discussed that determine if they're even qualified to take on that role?
That initial acceptance phase is foundational. The principal auditor must critically assess if their own participation is sufficient.
Can I handle this role?
Right. They consider the materiality of the portion they audit directly, their knowledge of the component's business, the risk of material misstatements in components audited by others, and their ability to perform sufficient additional procedures on those other components.
Materiality, knowledge, risk, ability for extra work.
Ensuring they have significant overall participation. This upfront assessment determines the feasibility.
Finally, a point that often creates significant confusion: the principal auditor's access to the component auditor's working papers. Can a principal auditor simply demand to see those working papers?
Very important point. Frequent misunderstanding. Remember, working papers are the property of the auditor who prepared them.
They belong to the component auditor.
Right. Under SA 230 and SQC 1, a principal auditor cannot demand the working papers of another auditor. Sharing is at the component auditor's discretion, provided it doesn't undermine their work or independence.
They can't demand them, so what can they do?
While direct demand is a no-go, there are other ways. They can ask for comprehensive written summaries of procedures and findings, engage in direct discussions about findings and procedures.
Ask for summaries, discuss things.
Yes, they may also choose to visit the component auditor's office to review summaries or discuss the work. So, effective collaboration and alternative methods are the professional approach, not demanding papers.
Collaboration, not confrontation. Got it. And just like that, we've taken an incredibly detailed deep dive into the intricate world of group audits. From understanding the fundamental concept of presenting a single economic entity, through the intricate dance of permanent and current period adjustments, the critical role and application of SA 600, and precisely how all this plays out in real-world scenarios designed to prepare you for your exam.
You now possess a comprehensive understanding of the responsibilities that rest with both parent companies and auditors when preparing and auditing consolidated financial statements. You're equipped with the precise terminology, the detailed audit considerations, and the specific procedures involved, allowing you to approach any case study or practical scenario with heightened confidence and a deeper understanding of the bare standards.
So, what does this all mean for you, the diligent learner preparing for that exam? It means you're not just memorizing rules or definitions, you're understanding the why behind them, the underlying principles that drive these complex requirements.
Exactly.
You're building a robust framework to critically analyze financial reporting in complex group structures, which is an invaluable skill far beyond any single exam.
Precisely. And here's a final thought for you to mull over as you continue to build on this knowledge. In an increasingly interconnected global business world where corporate groups span multiple countries and diverse regulatory frameworks, how might the role of the principal auditor need to evolve even further?
Interesting question.
What new challenges and opportunities might arise from the increasing integration of artificial intelligence and machine learning tools in consolidation processes? And how might that impact the very nature of audit evidence and assurance in the future?
AI in consolidation audits. Oh, wow. Something to definitely think about as you continue your journey of becoming a truly well-informed and forward-thinking professional. Thank you for joining us on this deep dive.
Thank you.
Be digging, keep learning, and we'll catch you next time.